Hey everyone, this is Paul, and I'm back with my video series Darn Good Advice. Today, part one of a two-part video so that it's small and digestible. Taking a look at the top 10, five in this video, five in part number two, top 10 myths associated with personal finance. We have them listed here. Let's go through the list. Myth number one, the most important thing you can do is start investing early. Well, what we're really talking about when we have these conversations is that we want you to benefit from the power of compounding interest over time. It is the singular secret to wealth creation. And when you see the mathematics of what happens over time, compounding, exponentially growing your earnings, you would understand why there is so much emphasis on starting early. But the myth is that you can just get started anytime with any amount. So if you're still paying your car loan and you're still paying your credit cards and you're still paying your student loans and you're just going to start investing because somebody told you it was a good idea and you're only putting a small amount towards your investment, I dub this as a myth because there's a better way. So the fact is that there really is a magic number that we're shooting for when we do our long-term investing. Now, what you see on this graph is a chart of comparing compounding earnings at 10%, the blue line, versus 5%, the green line. And I emphasize the rate of return because this graph will look the same whether you're putting away $500 a month or $100,000 a month. So wherever you are in your earning spectrum, the mathematics behind this graph are the same. So I'm talking to everybody when I show you these graphics. So there is a magic number, and the magic number that I have picked, this is a Paulism, is where the lines between a 10% return, average stock market return, and safer, protected, fixed income investments like bonds, CDs, high yield savings accounts, etc., where these lines really start to diverge from each other. And what we see is this thing called the hockey stick graph. This is where the lines really start to diverge. And it is this hockey stick graph that we're aiming for when we are becoming long term investors and letting the power of compound interest work its magic. It truly is magic. Look at that line going straight up in the air. So there is a magic number that around year 13-ish, we start to see the numbers divest from each other. And where I come in and separate fact from fiction is when I say I don't want you to just start investing early with whatever you can find. I would much rather you take a more surgical approach, eliminate your debts. And now not only are you becoming debt free and you're no longer incurring anywhere from 7% for a car loan to 35% on a credit card loan, you're freeing up bigger chunks of money that you can start putting towards your investment. And being able to invest with larger chunks of money will completely overcome any gap in time compared to the person who just starts trying to do everything at once and you're throwing a little money here and a little money there and just clean up your mess and put big chunks of money in and get to the magic number. Okay, so there is science here, there is mathematics here. When you get to this magic number, two things happen. First of all, the magic number is where we start seeing each year when we're earning our 10% annual return, which is the average of the S&P 500, the US stock market in general, over any 10-year or longer period. Okay, that's where this number comes from. It's a real number. We want those annual 10% numbers to be significant. That's when it gets exciting. That's when the graph gets bigger because once they get significant, each following year they're more significant, right? So it's exciting. It's very exciting. And what we're really aiming for is as soon as we can get to the magic number, whether you start early putting in pennies or you wait a few years and you start putting in dollars, What we really get is once we start hitting the magic number, we want to add as many years to the end of this wealth explosion where you are still young enough, active enough to go out and enjoy life. Becoming a millionaire when you're 95, no, not interested, right? I want my money when I'm young enough to enjoy it. What is this magic number Paul's talking about? Well, remember, it doesn't matter what your income level is, your standard of living is, at 10%, the graph is the graph. Okay. So focusing on the rate of return for my math throughout this presentation, I use $4,000 a year at 10%. Now, $4,000 is a significant number because it is the average number that Americans are putting into their IRA, their individual retirement accounts, every year. So even though the IRS allows us to contribute significantly more, the average person is putting in 4,000 a year, and at 10%, you will become a millionaire. So if the average schmuck can do this, so can you. So that's why I picked these numbers. So when we look at this on an Excel worksheet, now there's no magic here. I know it may look like an eye chart. Just take a look at the top left corner. We start with $4,000. We earn 10% every single year. We add our earnings in, and every year that we add $4,000, we add that in, and the number for the year ending becomes the year beginning, and the math just repeats. So no more hocus pocus. There's nothing complicated here. We're just earning 10% every year and letting our earnings compound. Okay, so here's the thing I want to show you when you play with a 10% number. At year number 8, year number 9, your earnings, remember in this example, we're putting in 4,000. The math would be the same if you were putting in 10,000. But at year number 8, year number 9, your earnings or your growth equal or exceed, and exceed is the key word because your numbers get bigger every year, equal or exceed your contributions. So at year number 8 or 9, definitely by 10, this machine is running on its own. It's delivering on its own what you were contributing. So this thing takes on a life of its own in just a very short amount of time. The other thing I want to show you is when we look at the yearly growth and we recognize that yes, those numbers get big, and yes, there is a point where the lines start to diverge away from each other, and we see this hockey stick technique happen, and we start seeing 10,000 a year, 12,000 a year, 16,000 a year annual growth numbers. Around year number 13 is where we start to see these big numbers show up. And I put these boxes in there so you can read the numbers through the box. But at year number 13, the magic number is $86,000, of which $52,000 came out of your pocket. So over the course of 13 years, you're going to put out 52,000. The account will grow on its own up until 86,000. That's the magic number according to my graphs here. So when you can get there, now you're building wealth. So starting early matters. What really matters is getting to the magic number as fast as you can. All right, myths number 2 and 3, they're very closely related. So let's tie them together for the sake of brevity. We want to invest in tax-free investments so that we don't have to pay money out in taxes to Uncle Sam. Well, they're true that I support the idea of tax-free, tax-deferred growth in any of the traditional retirement accounts. Your 401ks, Roth or not, your IRAs, Roth or not, and of course the state government equivalents, whatever those numbers happen to be. Where I separate myself from this idea of tax-free investing is when you start getting these con artists, and that's what they are, con artists, selling you in life insurance as an investment. This is indexed universal life, infinite banking. You can be your own banker. This is a wealth hack of the truly wealthy. It's what the Rockefellers do. Nonsense. Let me show you the bottom line. While those life insurance policies will do what they tell you it's going to do, although much of what they're doing is shrouded in confusion and secrecy, like taking out loans, not paying it back, but referring to it as tax-free income, building up this ridiculous cash value concept, most of which is just you overpaying in upfront, and then they'll let you borrow your own money and tell you that it's a tax-free loan. All loans are tax-free. It's so much nonsense. So here's what I want to show you. Here's what really matters. When you invest at 10% return, even in a taxable brokerage account, blue line, and you have to pay a 15%, which could be even zero depending on your income level, but at 15% long-term capital gains rate, red line, you always come out far ahead of, and I'm being very generous when I do this math, by the way, an 8% return through some of these insurance con scam ideas. There's no way on God's green earth you're getting 8% returns on all your money. These things are loaded with fees, loaded with commissions, loaded with the cost of the insurance itself, and then you can get some of this cash value creation, blah, blah, blah. Even if it worked as advertised and you were investing and paying income tax or capital gains tax, you'd still come out ahead of the green line in any situation. So this is a myth. Bust it. Myth number 4, the stock market's too risky. So I left this graphic up here because I want to show you a few things here. So there are no guarantees in the stock market. That's true. But the idea that you can take a smaller interest rate and it's not going to be a big deal, I'll just get into something a little safer at a lower rate of return, it's no big deal. Well, look at the difference, blue line, green line, between 8% and 10% earnings. Over time, that number is significant. Now, I pass no judgment on what is your personal risk tolerance. If you're not comfortable pursuing the S&P 500, especially as you start approaching retirement years, I understand. But mathematically, over the course of time, selecting cheaper, I should say cheaper, lower rate returns will have significant impact as the compounding effect takes place. And remember that if you're investing in and you're trying to find the next hot stock, it could be risky. Remember the dot-com craze? But if you're investing in well-established, stable companies, then much of the risk has already been remediated, and you're investing in very stable, high-performing, established, profitable companies. And remember, yes, the stock market does go up and down. And that's why I recommend that you don't watch the market on a daily basis. Good investors are buy and hold for the long term. It's boring to get wealthy. But the stock market goes up and down, but it goes up and down on an upward trend. And this is the S&P 500 since 2020 or 2010, all the way up until today. Look at that trend. Not a whole lot of risk there. All right, you're better off saving money in the bank. Saving money in the bank is very safe. Well, that is true, as your principal amount will be protected by the bank and by the federal government should the bank actually even go out of business. The myth comes in when you think that putting all of your money into a savings account instead of investing is the responsible thing to do. The reality is that savings accounts are used to protect money you need on a short-term basis. Getting married soon, buying a house soon, going to pay cash for a new car soon, that's not money we risk in the stock market because the market does go up and down and up and down. And the last thing you want to have happen is when the market is down, that happens to be when you want to buy your car or buy your house or get married and take your honeymoon. You don't want to sell at those low prices and then go, oh my, I don't have enough money to do what I wanted to do. Short term events that have a set date of execution, that's money that you protect in a savings account. Everything else is meant to be invested, and saving money in the bank is a loser always. Yes, you're going to protect your balance. Your numbers aren't going to change, but you're going to lose purchasing power through this evil thing called inflation. It always costs more in the future for the stuff that you could be buying today. The purchasing power of the US dollar goes down by about 2% a year. And if you're saving money in the bank, it's losing money while you hold on to it. And I would say that if there are the appropriate use cases to have money in a savings account, shift that money to a high yield savings account. And a little footnote, do your research. Make sure that when you find these online banks offering 4.5%, which is significantly higher than your brick and mortar bank, make sure they're FDIC insured. Okay, so that was my darn good advice on the first 5 financial myths. Check out video number 2. I'm going to put the link to it right up there. There you go. Click on that. I'll see you in the next video.